When my kids ask me, what's your greatest regret in life 20 or 30 years from now? It is so important to me that I don't say, I wish I had spent more time with you kids. So I'm learning to balance that out. And now I'm having to take a lot of the advice I've been giving clients for 20 plus years. Instead of giving 50% of my income to the IRS each year, hopefully I can snowball some of that. And so I'm starting to also invest.
Whatever the mind can conceive and believe, the mind can achieve.
Welcome to the Dream Big and Think Different podcast, where we inspire, impact, and empower.
Progress is impossible if you always do things the way you have always done things.
It's time to dream big. Here's your host, Dr. Sachin Maskey.
Hello, everyone. Welcome to another episode of Dream Big and Think Different podcast, where our mission is to inspire, impact, and empower millions of people. I'm your host, Dr. CPA, Mike Pine, all the way from Dallas, Texas, who has a very inspiring story that we all need to hear and learn. I'm honored and privileged to have Mike in our show. Thank you so much, Mike. How are you doing today?
I'm doing well. Thank you for having me here. I'm excited to be here, man. And I am a big dreamer. I think we all need to be.
I'm excited today for Mike having us. So he's an expert in the tax for about 15 years in this country. And when I realized back in 2018 that I was paying almost and investing in oil and gas, ATM, and all those things we're going to talk about today, and how to save taxes.
I'm a CPA. I happen to be one of those weird people who love taxes. Nothing gets sexier to me than taxes. Try to explain that to our clients and they just don't get it. But I'll do my best. Taxes are powerful, man. Like you said, most of us who have worked really hard to make a decent living, we look at the end of the year, you look in your personal financial statement, taxes are your biggest expense. Depending on where you live in this country, if you're making upwards of $250,000 or more a year, you're probably paying more than half of your income in taxes. And that doesn't need to be the case. I focus on tax, but most of you guys are listening are probably focused on investments and return on your investments, and that's important. But if you can reduce that 50% tax, at whatever your tax rate is, if you can reduce that and figure that into your ROI, how it snowballs year after year, and considering the time value of money, every dollar you can save in tax today could be $10 15 years from now. And it continues to have the ability to compound. So as part of anyone's overall financial strategy, you got to consider tax. And you can either do one of two things. You can allow yourself to basically make the choice to be a victim of our tax law, or you can utilize the tax code to leverage your investment and your financial freedom growth. That's why I'm here. That's my mission in life, to help people do that.
I wanted to just jump in your company that you founded, the Pine and Company CPAs. Can you tell me more about it? Like, what do you guys do and what do you guys focus on?
So I started the practice in 2011 as a sole proprietorship. And then eventually, I love tax. I don't like bookkeeping. Bookkeeping is traditionally a big part of what CPAs do. I God bless those who like it, because I don't. But as I was growing my tax practice, for every new tax return I'd add or tax client, I'd get 2 or 3 bookkeeping clients, and it just kept growing. And so I was looking for an alternative to find some help to do the bookkeeping and let me focus on the tax. So 2014, I found a bookkeeping firm that offered tax as an ancillary service, but really weren't doing a good job. But they had a bookkeeping team and staff, and I bought that firm. Williams and Company was the name of it, in 2014, and then turned that bookkeeping practice into more of a tax practice that offered some bookkeeping. Incidentally, years later, 3 years ago, we sold the bookkeeping practice just so we could focus only on tax. It was a weird thought. It was one of those where you had to dream big, because any CPA that's a relatively small firm would say, you got to offer bookkeeping. 1, that's your year-round revenue. 2, clients want a one-stop shop. But my passion is income tax planning, strategizing, saving. I can't stand bookkeeping. So we got rid of it. A lot of people thought it was a terrible idea, but what it was like taking the millstone off of our neck and being able to finally thrive. And then we started skyrocketing in growth, and we focused purely on tax strategy and saving. We're not a normal tax firm that will take any client. We don't do small 1040s. If we can offer tax strategy and planning to reimburse you for our costs, because our fees aren't cheap, then we're not a good CPA for you. Our clients are the clients we love to work with are ones that have tax problems, or I would call them tax opportunities, and they're willing to change the facts so that they don't pay so much in tax. And that's what we have a lot of fun doing. We do have a specialty in real estate. That's probably 2/3 of our practice. But that's not all that we do. The partnership tax that I learned at PwC is, giving me a specialization in partnership tax, which is hard to find in the CPA world. But with partnership tax, you can't help but find yourself, if you're good at it, doing real estate and doing oil and gas. And so that's the majority of our practice. But where we differentiate ourselves from most CPA firms out there is we're actually proactive tax strategists and partners with our clients, not tax preparers. Tax preparation, the compliance part, it's a necessary evil. It needs to be done right, especially if you're executing a really good and complicated tax strategy. But there's no value there. The value is in doing it ahead of time, proactively helping our clients save lots in taxes. Because once December 31st comes around, there's very little you can do to change your tax. You got to take action before the year's over. And that's kind of what we focus on.
Okay, so thanks for letting us know about that, your company, what it does. And I guess in today's topic, I was focusing more for doctors and dentists, mostly how can we help them? I know it's the end of the year. What are the few things that you suggest in terms of people can do to lower your tax burden, and and so that they can start working on that, and also for next year, what they can do.
Yeah. So one easy thing that I see, more than 1 out of 3 new physicians that come into our office to talk with us have this low hanging fruit that they should have done a while ago, and they don't. So if you're working as a self-employed physician, you're a contractor, 1099, which a lot of docs are doing now. You're paying 2 kinds of taxes on every dollar you make in income. You're paying your income tax, which you got to pay. You don't have to pay as much as you might think, but you got to pay it. But you're also paying self-employment tax, the payroll tax. So when you work for an employer, you get a W-2. Every dollar they pay you, they withhold 7.65% of your income up to a certain threshold to pay for Social Security and Medicare. And then that employer turns around and matches out of their expense an additional 7.65. So the IRS, Social Security Administration, is getting 15.3% of every dollar paid to you before you even consider income taxes. If you're set up as a sole proprietor or just a pass-through PLLC or PA as an S corp, you're paying those 2 taxes, and that's a big hit. 15.3% on your first 160 grand is over 20 grand in taxes. And then everything thereafter, you're paying 2.9% to Medicare. Even if you make $2 million, you make $2 million, you're paying $60,000 in Medicare tax for every dollar you make over that. One easy structure they can do is receive those contractor payments in either an LLC or a PA or a professional corporation. That's taxed. It can be taxed as an LLC to start off with, but then you file an S election to have it taxed as an S corp. What an S corp does is you are required as an owner of an S corp to pay yourself a reasonable wage via normal W-2. Anything there and after you can take as normal distribution and not be subject to payroll tax. So you make $1 million a year as 1099 by setting up an S corp and paying yourself a reasonable wage, maybe 180,000, 250. Everything after that wage you protect from SE tax, and that's an easy gimme. And I'm still surprised. This has been around for decades and decades, and still surprised every time I get a new physician or another professional that comes in and they're paying SE tax, self-employment tax. Why? You shouldn't pay that much. You got to pay some. So that's one easy gimme that if you're a physician getting 1099, you ought to consider doing immediately.
So question on that. So basically, just want to understand. So you're saying that if somebody is straight W-2, for example, myself, but I do have other investment that I do, which we're going to talk about. But somebody is not doing any investments, straight W-2. The strategy you just mentioned is to establish a structure and receive that W-2 income.
Not exactly. So if you're a W-2 employee, which half of physicians are, maybe 2/3 out there are, this
Absolutely.
doesn't work for you. But for those who are
Yeah.
receiving 1099 payments, contractor payments,
Gotcha.
those, whether it's your main source of income or you're moonlighting another practice and getting 1099, that's the income you can mitigate self-employment taxes out of. If you're a W-2 employee and that's all your income, it doesn't work for you.
Absolutely. I just want to be clear on that. So thank you for clarifying that. So
Yeah.
what would W-2 income earners can do to lower their taxes? For example, in the end of the year, right now we're in the middle of November. What would be the few things you can high level, like you can tell?
Yeah. Depends where you're at in your financial planning. If you're just finishing your residency, just starting to get paid, you don't have any investments, you've got a load of debt, all you're going to have from your W-2 paycheck is what we call active income. So you got an active tax problem or active tax opportunity. At that stage, you got to find ways or investments to reduce your active income on your tax return. Let me break out active real quick versus passive or portfolio.
Sure.
The IRS requires us to report income in one of three buckets. We're supposed to track it separately, report it separately, and we're taxed on it differently. You have your active income. That's the main bucket that we play with most of the time. That's income from wages from a business, whether you're self-employed or not, or pension income as well, retirement benefits. Those are all considered active. Then you have something called portfolio income, another bucket. On the portfolio income, that includes bank interest, dividends, truly passive portfolio, capital gains. All those are supposed to be tracked and netted separately in a portfolio bucket. Then in the middle, they have something called the passive income bucket. If you invest in multifamily housing and you're not a real estate professional, that K1 you get is going to come out as passive. And whether you have tax deductions or tax income, it's passive income. So for most physicians, their first few years of truly practicing, they don't have passive investments. They don't have passive income coming. They have an active income problem or an active income opportunity. So the biggest bang you get for the buck is to find investments that are going to provide you growth, that are going to give you a positive ROI, but that also provide active losses to offset your income. The biggest one that you can get into with being truly passive as an investor, and not the way the IRS calls it, but you being passive. Are you going to go work 500 hours a year building a vacation rental property, or you invest in oil and gas syndication and not do anything but receive your checks, hopefully? That's a passive investment. That's the only surefire way to get active deductions on your tax return, if you're structured correctly, to offset your active income. An example is, let's say you invest $100,000 in oil and gas fund. They deploy their capital right, report it right. You're going to get somewhere on the low end, 60% of your investment, upwards of 85, 88% of your investment back in the first year in something called intangible drilling costs, or IDC. Basically, all the costs to build a drilling well. It has to be a working interest for this to work. We can talk about the differences in a minute, but you would get, so you put in 100,000, you'll get 60 to 85, $88,000 on your K1 as a tax loss, not a cash loss, a tax loss. And because of the incentives in the Internal Revenue Code, those are allowed to be treated. Again, you got to structure it right, but those are allowed to be treated as active deductions. So if you had a $100,000 W-2, you put 100,000 in one of these oil and gas working interest, you get $80,000 of IDC deduction. Suddenly, your active income is your 100,000 W-2 minus your 80,000 IDC. You're only subject to taxes on the 20,000 remaining. And you have an investment. It's got to be a good investment. You have an investment that's going to continue to pay you dividends, distributions, and grow in value over time. That's the easiest, simplest thing to do come November before the year's over.
So that's amazing strategy. I have done myself, and this is a disclaimer, and I have reduced my tax liability after I started learning about this. The question is like, I don't know the exit strategy. For example, what happens once you get exited? What happens with the tax? It's basically there's two different ways you can reduce your tax. One is tax deferral that we're talking about, I guess.
Hmm.
Other one is tax elimination, right? So this
Yeah.
is not going to eliminate your tax, right? It's just deferring your tax.
Yes, but unlike with real property where you have something called depreciation recapture, there's no IDC recapture if you sell your investment or get it cashed out. But any
Okay.
taxable income you get in the future, any income you get in the future is going to be taxable. It could be ordinary income from operations of the oil and gas well, or it could be capital gain income from selling the investment or getting redeemed. So that's is it it's technically a deferral because ultimately as you get income and receive your capital back, that's going to be taxed.
Okay.
It is a deferral, but it's a in some ways it's a better deferral than depreciation deductions that you're going to ultimately
Gotcha.
have to deal with depreciation recapture.
Sounds good. Yeah, so basically, I think this is the strongest, one of the strongest strategy for straight W-2, where you can offset your active income with the active loss with the oil and gas.
Yeah.
I also have done something called conservative easement. I know this is not a very good strategy. A lot of time the IRS doesn't like this for the various reason, but can you just tell the listener about a little bit more about the conservative easement that they can do
Yeah.
this year?
A conservation easement is not buying an investment that's going to give you cash flow or ROI over the future. It's buying an immediate tax deduction.
Yes.
Things have changed in the legal and tax law landscape for conservation easements a lot this past year. So it used to be,
Yep.
let's say 2 years ago, you and I could get together and put in $500,000 each into a partnership we formed to go buy some real property, something that
Hmm.
that someone like the Sierra Club would love for us to give to them in a conservation easement, basically promising on that land we will never develop it. It's going to be used for bird watching or some other conservation type deal in
Hmm.
perpetuity. So we would put $1 million in, and let's say we would borrow, if we could leverage it really greatly, get $5 million worth of property leveraged.
Hmm.
So we put in our $1 million, we get $400,000 of debt, we got a $500,000 cost of property. And then we turn
Hmm.
around and give the conservation easement. When you do a conservation easement, you still own the property. You just don't own the rights to develop it. It's whatever you build into the easement
Absolutely.
language. But by doing that, up until a year or two ago, you could get a $5 million 5x tax deduction as a charitable contribution. So
Hmm.
$1 million gets you $5 million deduction. If you're paying 37% tax, you get a much better tax savings that greatly exceeds what you actually had to invest to get that. And that's been going
Hmm.
on for decades.
Yeah.
It's written in the tax code. The IRS has hated that. And for the last
Uh-huh.
decade, they really started trying to push back on it. And they took it to tax court multiple times. And the way the law had been written at the time, they
Yeah.
lost. As long as it was genuine, you really conveyed the conservation easement, you really had debt on that property, you could do it. IRS didn't like that. A couple of years ago, I read an article in one of our trade journals where the IRS had over 600 in-house attorneys at the Treasury Department trying to find a way to stop this because their
Wow.
argument, and ultimately they've won it, their argument was that is not the intention of why charitable deductions are allowed. People are abusing
Hmm.
that. So they've
Absolutely.
got some
Yeah.
new laws that were written, part of the Inflation Reduction Act, and just other rulings. Now that ain't gonna fly. You can
Yeah.
get they made it a lot harder. You can maybe get a 2.5x charitable contribution doing the same strategy. You can't get the 5x now. If you do, you're in a tax shelter, the IRS can come after you and you're gonna lose.
Absolutely. Yeah.
If it's more reasonable, you can get it. So
Yep.
I never liked it, Sachin, because you're buying a tax deduction, you're never going to get an ROI. Yes, when you consider time value of money, if I put in 100,000 and I save $180,000 in taxes, that $80,000 delta is real. It's not a deferral, it's a lifetime change. That's real.
Yeah.
But that $80,000 delta is all I'll ever get from that investment. I don't have an investment working for me. I'm not snowballing my wealth. But there were times where people didn't have anything else they could do. It's December 1st. They knew they're going to pay a ton in tax. It's a great idea. That doesn't work
Absolutely.
anymore as well as it did. There's other things like there's this Novoderm investment out there now where you still get a 5x return. It's physicians got this together. You physicians are interesting breed of thinkers, but they're using cows, bovine, to create skin from.
That's interesting.
It's really interesting. So they use, let's say I'm a burn victim and I need some skin replacement or treatment. They use my skin cells in a cow to create more kind of skin that can then be put back on my arm, and it works really well with little rejection. And it's big. It's taken off pretty big here down in the hospital system in Texas. So Novoderm, the people who've created this, have created these partnerships where people go in and invest to build the scaffolding and everything it creates to make these skin cells. And they only can be used once, and then you have to start from scratch again. And then they're donating it to one of the larger hospital systems here in Texas. But when they're donating it, the Texas hospital system says, hey, even though you only put $100,000 into building this skin stuff or skin replacement stuff, we're having to pay $500,000 in the market for it. So you get your 5x return. We're going to give you a $5,000 charitable contribution if you and all of your partners, they usually do it, I think, in 10 or 20 individual partners per unit into one partnership. So at the end of the year, you can choose, the partners have to vote, but you can choose to either keep the investment, make money over time, not get any charitable contributions, you just get the ROI on the investment, or go ahead and donate all the underlying assets to the hospital. It uses a different section of tax law, a different area of tax cases, tax court case precedent. And so far, it looks pretty darn legitimate. The Novoderm people that are marketing this, they've hired a really good tax law firm here in Dallas, and they stand by it. They will, if you get challenged on your charitable contribution, they say that, and I think it's written in the subscription agreement, their law firm will come represent that, any challenge to that charitable contribution. So there's still some ways to do it. Again, Sachin, I don't like it because I'm buying a tax deduction once and it's over. And I don't get that deduction unless I vote with the partners to contribute it to charity. I want an investment that's going to grow and help build my financial freedom. If you're in a pinch, it's something you could still do this year, and you could do it, as late as early December and still get that deduction for this year. But I'd much rather buy something like a good oil and gas working interest or something similar.
You're listening to the Dream Big and Think Different podcast with Dr. Sachin Maskey. Be sure to stop by sachinmaskeymd.com to download a free copy of Dr. Maskey's book.
One thing I want to discuss briefly about real estate professional status, reps, which is called, if you can kind of tell like about 1 or 2 minute how people can benefit, because a lot of physicians, some of, like not a lot, but like some of them, one of the like spouse is not working, for example, and they buy a real estate, and because of the spouse who is not working full time can basically qualify for reps or real estate professional status and have the active help the husband to offset the active income. If you can kind of explore a little bit more about it.
Internal Revenue Code 469, the passive activity rules, says they qualify things like long-term rentals, commercial rentals, construction development. They call it a category of real estate professional activities. And those generate, you buy multifamily housing, go buy an apartment complex in a syndication. That's multifamily housing. That's a real estate professional activity. It's going to spin off, if done right by the operators, a good amount of depreciation in the first year, and additional depreciation. That's a big
Absolutely.
tax loss, not a cash loss, tax loss. However, unless you're a real estate professional, according to the passive activity loss rules, that's a passive loss, and you can't use that to offset your active income.
Active. Yes.
Unless you or your spouse is a real estate professional. If you are,
Mhm.
you have entered the promised land of taxes. Real
Yes.
estate tax has so many opportunities and incentives out there for good
Mhm.
reason. We need
Yes.
housing in this country. We don't have enough of it. So there's the incentives, and that's how our laws get created to incentivize the economy to produce more housing. There you go. You get to
Mhm.
take that depreciation. And if you're a real estate professional, you don't pay any taxes, or you pay much less in taxes. To be a real estate
Right.
professional is not that easy, though. There's
Yes.
2 hurdles you have to hit. The first
There's
hurdle is
always a
easy.
caveat.
Yes. There's always a caveat. The
Yeah.
first hurdle's easy. Well, not easy, relatively easy. You got to spend 750 hours in a tax year working on real estate professional activities. That's not that hard. It's just under 15 hours a week all year, 750 hours. If that were it, we would all be real estate professionals. The other hurdle is you have to spend more of your time in a tax year on real estate professional activities than you do all of your other professional activities. Well,
Mhm.
I spend 2,500 hours at least a year working as a CPA. I would have to
Mhm.
spend 2,600, 2,501 hours on real estate professional activities before I could qualify. Not going to happen. There's not enough time in the day. So I
Right.
can't do it. But if you have a spouse that's not working, and is willing to do this, you can't force your spouse to do it. Divorces are a lot more expensive than taxes. But if you have a
That's
spouse
true.
that is interested and becomes a real estate professional, because they don't have other professional hours, they just need that 750 plus 1 minute to qualify as a real estate professional, then you, if you're married, you are both one unit. You're married filing jointly. You get to share each other's tax attributes. So suddenly y'all become a real estate professional filing. And if there's other caveats and other hurdles you have to jump over, but then you invest in a syndication that spins off depreciation. It's not passive anymore. It can be active. You still have to materially participate in some real estate professional activity. That you can have a single family rental, you self-manage it, you're a material participant in it, then you can make an election. Your tax advisor needs to make an election on your tax return to group your syndication, your otherwise passive investments, with your material participation in that real estate activity. And now that depreciation that comes through in your K1 can reduce your W-2 or your other active income.
Wow. Yeah, I mean, that definitely a major benefit for somebody who can actually do it. But just to, I mean, if you need more information, definitely Mike is can help us to go more details if somebody wants to learn more about that. Again, due to the time, and there's so many things that we can talk, but we did mention oil and gas, a conservative easement this year people can do. And I also am looking at something called ATM investment, which we don't have time to talk more.
But it has
But
great
also,
passive deductions that can be used to offset passive. Let me, before
yes,
we move on, I know we're running out of time here.
yes,
So often I hear potential investors that are looking at investing in real estate in syndication. And they say, well, I'm not a real estate professional, so all these depreciation will be passive losses. So it really doesn't do anything for me. That is not
right.
true. And I want people to understand that. Even if you can't take those real estate investments and the depreciation from them, or the ATM funds depreciation, and move it to your active column, there's 2 things that it does that really improves your ROI and helps
Mm-hmm.
that snowball effect for building your financial freedom. So let's just say I invest in one real estate syndication. It's my only investment. I put in 100,000. I get 75,000 of depreciation allocated to me. I can't take that 75,000 depreciation and offset my active income. It's a passive loss. It sticks there, but I do get benefit from it. Suddenly, the first $75,000 of operating income and operating distributions I get from that investment are tax-free, because I get to apply that income and offset it with my passive activity loss carryover. So
Mm-hmm.
underwrite that. You look at the ROI growth. If you're getting 8%, 12% distributions being tax-free for 5, 6, 7 years because of your depreciation, and you turn around and reinvest that, it compounds, your growth compounds a lot faster, a lot stronger than if you just invested the same 100,000 in Bank of America stock and got 12% dividends, which you'll never get. Your after-tax money is big. All right, let's say you actually have been investing for a while and you got 4 or 5 passive investments that are spinning off income. You're paying tax on that income unless you have more passive activity losses that your preparer groups together on your tax return and uses it to offset your other income. So like this depreciation ATM, I assume you're doing that with Dave Zook. That if you have passive income from other places and you put 100,000 in now and get an $80,000 deduction, suddenly you're able to eliminate or offset $80,000 of taxable income from your other passive activities if you do it right on your tax return. So whether or not you're a real estate professional or not, whether you're investing in real estate or something else, passive investments, passive losses, tax losses, not actual losses, tax losses, can help you greatly, and you can still snowball your effect. Not as fast as if you can bring it on the active column, but still pretty damn fast.
Absolutely, absolutely. So you're saying that if somebody has multiple investment, I have like 7K ones myself, so it's always better to have the passive loss to offset our other passive income, right?
Not always, but most often, yes. It's always good to have that option, right? Sometimes you want to time it to a different year where you're in a higher income tax bracket, but no, that is not worthless to you. Like I've heard so many errant potential clients tell me, it is valuable to you, very valuable.
Yeah. I mean, again, there's so many things we can talk about. Maybe we can have another, so just to talk about specific topic like tax credit by doing a solar panel. You save $30,000 yourself, as you were mentioning before this. So, and also you can pay your kids, and have some income distributed to lower your tax burden. There's so many things, right? Giving back.
So many ways. If I can, I know we're late and I'm running late to me, but let me just kind of close with this. Sure. When you can put your head in the sand because taxes are complicated and annoying, or you can choose to recognize them for what they are. And the tax code, this is what our society has gotten together and said, these are the things we need business and our economy to do in our country to make us more secure nationally, to provide better quality of life for our country. These are things we need. And if you do these things and play the game that we want you to as the US government, we will give you tax incentives. So the Internal Revenue Code is really the yellow brick road to financial freedom. Use it to leverage your financial growth. Don't be a victim to it. And the only difference between being a victim to the tax code or using it to grow your financial wealth is you deciding to make a choice that you're going to use it and understand it. So I love tax.
No, it takes time and dedication, but absolutely true what you just said. I have 2 more questions before you leave. Just want to make sure that's my, all the question I ask for my guests. So the second question would be, what is your biggest win in your life, Mike, and how you define success?
I'm just going to be squishy on this, but no doubt the biggest win in my life was my wife. I don't know how I was able to convince her to marry me. But that's been the biggest win. And then the kids that we've had together are amazing. How do I define success? Having the freedom to live a life that honors your creator, if you believe in that, honors your faith, and provides you some confidence in knowing you are achieving the impact that you want to achieve in this life. That's success to me. I don't care if you're a millionaire, if you're a day laborer, being able to live this life and make an impact to whatever is your important mission, but to change that, to improve it in this life, that's success. We have a short life, man. We don't live long.
Absolutely. Contribution to the community and, serving others is definitely something I am doing personally myself. That's when I started this podcast to impact, inspire, empower people. So I totally agree with that. Last question for today, simple, where people can find you and what is the one thing you want to share before you leave?
check out our podcasts. We've created the same reason that you did. We want people. They don't have to be our clients. We want people to leverage off the tax code to help build their financial freedom and our national economic security. Hiddenmoney.com. You'll find plenty of calls to action there if you want to join a mailing list, or if you want to schedule a consultation with us, it'll link you over to the firm's website at pinecocpas.com. But the last thing I want to leave, guys, take action. It's your choice. Don't be a victim to taxes. Leverage them. Use them. Thank you, Sachin.
Absolutely. What is the website you said? Hiddenmoney.com is one of the...
Hiddenmoney.com. That's the main one. Go there and you can always get linked back to our firm's website.
Okay, absolutely. Thank you so much, Mike. It was an absolute pleasure. And definitely we need to have another session about more tax strategy. And I really appreciate your time. You're doing amazing. Anybody listening or watching, please share and subscribe and reach out to Mike and help to reduce your tax. Thank you so much.
Thank you, Sachin. Take care, man.
Thank you for listening to today's episode of Dream Big and Think Different. We hope you enjoyed it. Please be sure to subscribe to our show so you don't miss any gold nuggets. And we'd appreciate it if you could rate and leave us a review on iTunes, Spotify, and other platforms. Until next time.